Good morning, ladies and gentlemen. If you can hear me, welcome. I'm just going to wait 5 more minutes until 12 o'clock before we will officially start. Ladies and gentlemen, about 2 minutes and then we'll start with the session. Okay, good morning, ladies and gentlemen. My name is still Andre Steyn. I've presented the second class about 2 weeks ago on Learning Unit 2. I hope you've studied a lot since we've spoken the last time, and I hope you're a bit more comfortable after the first 3 classes. And still the same as with the second class, it is a pity that we need to present the classes the way we do now, because I can understand it's a bit challenging for you, but it's also challenging for us as lecturers, as it's better for us to also present these classes in front of you, and then we can communicate to each other and see the expressions where you struggle or not struggle. But anyway, let's make the best of what we have. So the module email address and the lecture is still the same. I just want to put emphasis on, if you've got any issues on the module, please contact us at FAC3704 FAC3704@unisa.ac.za. So that's the course email address. We respond normally within 24 hours, obviously not over weekends, but please make use of the email address. We are there to assist you. And then contact numbers, we've got the contact numbers on the right hand side as well. You're more than welcome to phone us on those numbers, but sometimes we are busy on the telephone, and then you phone, and then obviously we can't see who are phoning us. So that's why we say the preferred method is email. We said that the previous time as well. We are obviously the 3704 lecturers. So our main aim is to assist you with the course material of FAC 3704. So if you have any administrative queries, these are your two options. So please make use of these two options. And again, my preference is always to use email, because then you've got track of anything, or an audit trail or track of anything that you've requested. So that's just my opinion. So you can decide what works best for you. Facet, we said previously that this is a project running by Facet. So we talked about the Facet contracts in the past. So if you haven't completed your Facet contract, we would appreciate if you can please complete the Facet contracts on the announcements on My UNISA, and send them to caststudentsupport@unisa.ac.za. Or any other questions that you have, you can also, on the Facet class, you can also send your request to them. Q&As, the questions and answers. I have not activated the questions and answers on this specific session. For me, it's just, I think it's a bit confusing, because I can't stop while it's a live session and go and read what questions you ask, and then it might irritate some of the people. So this is one of those things. Some will not like it that I've switched it off, and others will appreciate it. So that again was my choice. So what I want you to do is, if you've got any issues on the class or anything else, you're more than welcome to send us an email to the course email address. While I'm going to present this discussion, obviously I'm not going to answer the questions, but either later today or alternatively during the week, we will answer all your questions. Okay. So what is the objective of this session from my side? It's basically the same as in my second class. It's to explain the basic principles of investment in associates and joint arrangements to you. So obviously in the second class, it was on subsidiaries. This time it's investments in associates and joint arrangements. I want to give you examples and exam technique, and to tell you how to approach a question, because we're going to go through examples and we're going to go through a question. And then I want you to show you how to get the easy marks. Well, 2 and 3 walks a little bit hand in hand. And then how to approach your studies or the way forward. Explain the type of questions in an examination. Emphasize how important a good year mark is, and repeat students do something different. So this is basically, I've said that in the second session, and I'm just going to touch a little bit on it today as well. So those 7 points, I'm going to touch on points 4 to 7 first. So how to approach your studies going forward, start early. And I said that 2 weeks ago. Obviously, you can see how quick time goes by. So if you haven't started studying, I really think it's now the time. There's around 2 months left before the exam. And if you're not going to start, you're going to wipe out your eyes, and then you're going to see it's exam time and then you haven't studied. And it's your choice. If you want to pass this module, sit and study, and then you will pass it. There's sufficient time left. Know the basics. I said that in the past as well. Know the basics of each learning unit. Okay? If you've got a one-page summary of the basics, and you will see in the questions, the basics repeat itself the whole time. If you know those basics, there's going to be a good chance you already passed by just using those basics. So get yourself a one-page summary of each learning unit, know the principles, and then you exercise by doing questions under exam conditions. And that's really important. That's questions in tutorial letter 102. That's your easier questions. Then tutorial letter 103 is basically old exam questions, or it's questions on exam standard. And then on My UNISA, you'll also find the old exam questions. Now that's really important. Do these questions as if you are sitting in the exam. Do not look at the solutions. Well, luckily for the exam questions on My UNISA, you don't have the solutions available. Then you do the questions in tutorial letter 103 as if you're sitting in the exam. And then actually the more important part, when you're done, you mark yourself. And when you mark your question, always ask yourself why. What is it that you have on your solution that we don't have on our solutions? And then ask yourself why. Because there's a reason that you've put something on your solution, but it's not on ours. And obviously, then it's a mistake. And then other way around, if there's something on our solution, not on your solution, why? Ask yourself why. If you can't get the answer to the why, then contact us. I'm going to say this again a few times, maybe in this discussion. You will see that in our solution, sometimes we've got explanatory notes or certain calculations, for example, and analysis. Okay, you will see throughout this module that we make use of analysis a lot. Be careful that the analysis is not part of disclosure. It's just a method for you, or a calculation way how you can get to your answers. So some students do the analysis and then they think they're done, and then you don't get any marks because you haven't answered the question. So please take note of that, ladies and gentlemen. It's really important. We see students doing that, doing the analysis, and then they can come back to us after the exam or maybe an assignment, and they don't understand why it wasn't marked. The reason why it's not marked, it's a calculation. If you haven't disclosed the information, you will not get the marks. Okay, the type of questions, I'm going to go quickly through that. It's discussion questions. Again, that's relatively new. So look at any questions that you can get where we ask discussion questions and see how we answer it, so that you can learn, because I can guarantee you in future there will be discussion questions. Calculations, we might ask you a calculation, and then yes, then you don't have to disclose. If I ask you calculate the NCI for me or calculate the goodwill for me, that's what I then ask, then you don't have to do the disclosure. And that's the same for journals. There will always be multiple choice questions, not a lot in the exam, maybe 3, 4, 5. And for us, sometimes it's a bit sad when we mark the exam scripts and we see those multiple choice questions wasn't answered. Ladies and gentlemen, I know it's not maybe the 100% correct way, but if you do not have time for the answer, which actually, if that's the case, your exam technique wasn't good, because you should make sure you prioritize time for each question. But let's say you've made a little bit of a mistake and you do not have the time, at least guess. Okay, then you might win the lotto that way. Okay, financial statements and notes, and you'll go through all questions and you'll see that's most of the times a lot of the marks that we require. Okay, emphasis, how important a good year mark is. I'm going to say that again, and I know I repeat myself from my second session, but maybe there's some newcomers to this session who did not listen to the second one, to the second discussion class. Please, this is really important. And I said the last time as well, it's to make sure you work throughout the year when you do your assignment. It's to test your knowledge and to get the progress, how you progress with this module. And then obviously to get a good year mark, make it easier for yourself to pass. And then repeat students, I said that as well. Do something different. If you can't figure it out, contact us as lecturers on the email address and say to us, this is the approach that I followed so far, and this is what I've done, this is what I think I know and not know, and let us help you to work out a plan how you can make this module easier and how you can pass it. The point is, the crux is, there's no easy way out here, okay? You will have to study, and you will have to study hard. And some people will have to spend more hours than others, and only you can tell yourself. So obviously, if you've done this 3 or 4 times, maybe you should put in a little bit more hours and do something different. I've said in the previous class as well, this is obviously only 2 hours that we have. So this is not enough to cover everything in Learning Unit 3 or 4 and 5. So please, the discussion classes on its own is methods to assist you, to make it easier for you, but you will not pass if you just do this. You need to put in the time and the effort. Okay, so points 1 to 3 of my objectives will be covered through the remaining slides of the session, and I will do a few explanations, a few examples, and then questions. We will look at particularly question 2 of tutorial letter 103. So a summary of the class. The first class was business combinations presented by Mr. Jacques van Staren, and a few things that I want you to go and have a look there to make sure you know what it is what is control, what is significant influence, joint control, and then non-controlling interest. How do you account for non-controlling interest? And then the goodwill or gain on bargain purchase. Okay, so this is a few things. If you do not know these terminology by now, if you do not know that when you see control, either by the words control or something in the sentences that we give, you should be able to know, okay, we're working with a subsidiary here. Okay, significant influence, then you need to know, okay, this is an associate. This is just a few examples. Okay, goodwill or gain on bargain purchases, sometimes students really struggle with this. Goodwill is the one where when you pay, you buy shares in another company and you pay more, okay, than the net asset value of that company. So if you pay more for something, there's an asset sitting there that you can't see, and that asset we call goodwill. And the gain on bargain purchase again is when you pay less. When you pay less for something, you get a bargain. So that's the gain on bargain purchase. That's just in short a simple explanation. Items, you need to make sure you understand what all of them mean. If you do not understand, please contact us. In the second class, we said, okay, now we know what a group of companies is. So now we need to look at the consolidation procedures, and we need to then eliminate the intra-group balances and intra-group transactions and their resulting unrealized profits. Okay. So in other words, you're going to get a group of companies in a question. You need to identify, okay, what do I have here? And then we said with a consolidation of a subsidiary, it's easy. You just add everything 100% together. Go and listen to the second class. And then you need to do this elimination and the pro forma consolidation journal entries. And then something you need to look out is the impairment of goodwill. Most of the times it's in the question, and then students struggle, and I think I've explained that in the second session as well. And then it's the preparation of the final statements, which is your statement of profit or loss and other comprehensive income, statement of changes in equity, and statement of changes in financial position. So that's the 3 that we mostly ask. The third class, complex groups. This is now where it's becoming a little bit more difficult. So you need to look at the consolidation working papers, and I've highlighted it there, consolidation working papers. It's just working papers, calculations. And then look at the last sentence there. You're going to use that to prepare and present your consolidated financial statements. I just want you to go and have a look at this table. You can do that at the end in your own time. It's just a nice little summary to show you, to explain to you, okay, the degree of influence as an example. It's where there's control, okay, that's a subsidiary. And what do I have to do according to the accounting standards? You can go and look at this, make sure you understand and know this table, and then as well the summary or diagram on page 13 of tutorial letter. I've made a mistake here, not tutorial letter 103, it's tutorial letter 501, the study guide. I apologize for this error. So just go and look at them. That's just a small summary to make sure you know all these terminology that you need to use, and the flow and the methods, how to get to, is it a subsidiary, what is my accounting methods, and so forth. Okay, so what are we doing today? We're doing today Learning Unit 4, Accounting for Investment in Associates. And recap, when is an entity a subsidiary? It's when there's control. And I've said to you then, when there's control and it's a subsidiary, you're going to add 100% of the company and the subsidiary to your consolidated financial statements. And then there's a few other things that you need to do. Calculation of goodwill or gain on bargain purchase, non-controlling interest, and intergroup transactions, and so on. That's just a recap. Okay. When is an entity an associate? Okay, when there's significant influence. So it's the power to participate in financial and operating policy decisions. And the presumption is that 20% or more of the voting rights provides significant influence. So now you need to look between a subsidiary and an associate. First thing you need to identify in the exam, we're going to give you a set of information and we will give you something in that question. And that something can be a word, or it can be a sentence or a paragraph, or even sometimes figures that you need to use, and you will only be able to get used to it while you're doing exercises. And you will then need to identify, is this now a subsidiary? Because there will always be the parent or the investor. And is the other companies a subsidiary or is it an associate? Because the treatment of them is differently. So the subsidiary, you will add 100% of both the investor or parent and the subsidiary, line by line, as I said. But with the associate, there's something different. It's a bit different. Take note, you will not add 100% of the line items of the associate. Students make these mistakes in the exam, and then they don't understand why they lose these easy marks. They add it and then they think, but I've written everything that was given to me on my answer sheet. But then you miss the basic of what an associate is and how the accounting treatment works. Okay, so how do you account for it? So you will take the cost plus the since equity movement and all other changes in the equity since acquisition. On the cost side, you will see the cost of this investment. In other words, the cost that we will give to you in the trial balance of the information given. So the cost in the books of this investor or parent will already include goodwill. So you will not have a pro forma journal entry for goodwill. So any access recognized as part of the share in the profit of associate, there will be a pro forma journal entry required for that. Okay, at the plus side, just look at what was highlighted, since. In other words, since acquisition. So you need to draw yourself a timeline to see, okay, when was acquisition? When is my financial year I'm reporting on? And what happened in between as well? That is the since portion. And then the changes in equity since, you can go and read through everything there on your own side, on your own time. I want to put the emphasis on this dividends received. This dividends received, that's now received by the investor, in other words, paid by this associate, will reduce the carrying amount of the investment in associate or joint venture. You'll see later on, when I do an example, I will touch on an example on this specific dividends. But take note of it, because that's normally the other things that we add and it's so easy to get these marks that I want you to not forget this. Okay. Accounting for interest, that was now learning unit 4. Associates, but we'll go through examples now, but that's really how easy it actually is. If you really understand the basics, you will see now in the examples, it's really easy. So learning unit 5 is the accounting for interest in joint arrangements. Okay, so what is a joint arrangement? It's where 2 or more parties have joint control. So you get 2 categories. First, joint operations. Okay, that is when the parties in this arrangement have the right to assets and the obligation to the liabilities of this operation or this arrangement. On this one, on this category, I want you to know that you only need to know the theory, and we will only ask a small theory question on joint operations. Okay, so that's obviously an easy one. So joint ventures, that's when the parties in this arrangement have rights to the net assets or the equity. Remember, another word for net assets is your equity of this arrangement. So that's what I want you to know on joint arrangements. Okay, joint ventures, not like joint operations. Joint ventures, we will ask practical questions in the exam. But what I want you to know from now on is that the joint venture is accounted for according to IS 28, the equity method, exactly the same as associates. So the only difference is the wording or the description of the disclosure line item. And you'll see now in the examples, I'll give you a few examples just now. So in short, joint arrangements, you get joint operations, you only know the theory for a theoretical question. And then joint ventures is actually exactly the same. You treat it exactly the same as an associate. It's just the description or the wording that will differ. Okay, I've made it blue here. So the accounting for associate and joint venture, I've just said, treat them the same. So look here, the associate is the blue one and the joint venture is the green one. Okay, so only 2 to 3 line items will be included in your financials at the percentage interest held for the associate and in the other one for the joint venture. So if you remember, with the subsidiaries, we include all line items with a few exceptions like the share capital, but most of the line items will include 100% of the parent or investor and 100% of the subsidiary, whereas with the associate or joint venture, you will only have 3 line items that you will include in your consolidated financial statements. That is firstly your investment in associate in the statement of financial position. So you will typically in your asset section have a line item investment in associate, for example, ABC Limited. And then share of profit of associate in your statement of profit or loss and other comprehensive income, and share of other comprehensive income of associate as well in your statement of profit and loss and other comprehensive income, but under the other comprehensive income section. Okay, so go and look at examples there and make sure, can you see there's 3 different line items that you did not have at the normal consolidation of a subsidiary. So that's where students make the mistake. So normally, because the information is given in the question, for example, property, plant and equipment for the parent and property, plant and equipment for the subsidiary, because we give you the amounts, we test the principle, do you know you need to add those 2 amounts together? So we don't give for the description normally a mark. But for this one, investment in associate, as an example, we will normally give a mark because we'll say, okay, in the information given, this specific line was not given to you. So you will have to know this and you will have to put this into your answer and then we'll award the mark. Again, if you call it something else, for example, in the trial balance, we will say investment at ABC Limited in the parent's books, 100 Rand. Then you need to know, whoa, I need to change that. I need to reclassify that to investment in associate. so that the readers of the statements can see, okay, whoa, there's an associate in this group of companies. Okay, and as I said, associate and joint venture, exactly the same things, just the wording that differ. Look here at the bottom, is exactly the green ones. It's exactly the same line items that you will have. The only difference is the wording joint venture instead of associate. So now you need to read carefully in the exam, because sometimes in the exam, we will give this information and you'll work out the percentage and then you'll see, no, but whoa, this is now, and you think, for example, a joint venture, but then it was an associate. And then you write in the exam, investment in joint venture, but it's an associate. And then you will not get the mark. You will get the mark for the calculations for the amounts, because they should be the same. But for the disclosure, the description, this line item, you will not get your marks. Okay, so now you can see this is actually not difficult. So let's look at a few examples. Okay, from this slide onwards, I just want to say, if I refer to associate or joint venture in an example, it can be for any of the two, because I said to you the treatment is the same, only the wording or description or classification differ. So please take note of that, because my examples to follow, the principle on the calculations and the amounts will be exactly the same. Okay, example, when PPE was sold. Okay, the associate has a profit at year end after tax of 100,000 Rand. The investor interest is 40%. I want to stop there. When we give you, and we will in the exam, a question where there's an associate or a joint venture in one of the companies, you need to know this percentage. You will have to, and you'll see as we go on now in the example, use this 40%. In other words, multiply your amounts with this 40%. Because sometimes students do have their, let's say, the journals or the amounts correct, but then they forget to multiply it with this 40%. And then you do not get your marks. You do not get your marks because we say, whoa, there's a difference between the treatment of a subsidiary and an associate or joint venture, and the student did not use that percentage. So we do not know if you know that principle. And if you do not know the principle, we can't award you that mark. So please make sure at an associate or joint venture you use this 40% or whatever the rate is given in the question, or what you need to calculate based on the number of shares purchased, so that you use it. If you've used the wrong rate, say for example we gave you shares and we say, no, this entity bought 4 shares or 5 shares out of the 11 shares, and you use 40% because 5 out of 11 is not 40%. We'll penalize you one time for your error and then we'll mark with it. But if you do not use this principle, the 40% throughout, you're going to lose marks. Okay, so let's continue with this example. The property, plant and equipment sold by the associate to the investor. So can you see I wrote here upstream or upward? You'll see sometimes we talk about upward or downward, or upstream and downstream. You need to see who was the entity buying and who was the entity selling, and then ask logically for yourself, okay, in this case, if the PPE was sold by the associate and there's unrealized profit in there, that profit is sitting in the books of the associate, and that property, plant and equipment item is now sitting in the books of the investor. And obviously with a downstream, it's the other way around. So you need to go and look at the examples of property, plant and equipment, and for example, inventory, and you will have to go and make sure you understand and or remember, what will I do when it's an upstream or a downstream transaction? Okay, let's go on. PPE is sold by the associate at the year end with a profit of 10,000 Rand. Okay, the tax rate 28%. I've said in the previous class as well, always remember your tax effect. Okay. Let's look at this. And I know there's a lot of information on this slide. I want you to look at let's just go one slide back. See the blue there? Upstream. We're using the upstream example here. So on the left-hand side, the journal and the information is for upstream. Okay. On the right-hand side is just when the sale was downstream. So in this side, why do we say upstream? It's the associate who sold it to the investor. Okay. So the green information here is just the information given. So what will my consolidation journal look like? My consolidation journal will be share of profit in associate or joint venture, 2,880 Rand. How do I get to that amount? Just look above there in black. It's the profit of 10,000 Rand. We gave you the profit in this example. In other questions, we can give you information to get to this profit. For example, I can tell you the associate have an asset with a carrying amount of 30,000 Rand, and that associate sold it now to the investor for 40,000 Rand. Obviously, that difference you need to know then is the profit. In this example, I gave you the profit. So the profit of 10,000 Rand, remember what I've just said, multiply by 40%. That's the interest in the associate. So that's the 4,000 Rand that we're going to use. Then the tax effect on that is 28%. So deduct the tax. So the net effect is 2,880 Rand. Okay. So remember, we only bring this one line item into the financial statements in the consolidation statements when there's an associate or JV. So that's why the net effect you will bring in. So it will reduce the profit. So reduce the share of profit in associate by 2,880 Rand. That's a consolidation journal. The credit, the PPE. Okay, so this investor bought this asset and paid 10,000 Rand more than what the group paid for this. Okay, so that is unrealized profit that did not went out to an external party. So if it did not went out to an external party, then we need to take it out of the books. So we're going to reduce the PPE of the investor. Why only 4,000 Rand? Only the interest, the 40% interest in this associate. Can you see what I said earlier? How important it is to remember the 4,000 Rand. And then the deferred tax there of 1,120 Rand. Okay, so why is this deferred tax a debit? If we can go up just there to the calculation, we said this is unrealized profit, the 4,000 Rand. Okay, if it's unrealized profit, in other words, it's not profit that the group made by selling this asset to the external or third parties, we say, okay, so now for consolidation, we have lesser profit. If we have lesser profit, we have less tax. Less tax is a credit of income tax, which is now included in the share of profit line item. And the other side of this credit of the income tax is then your deferred tax. It's deferred until this asset will be used or sold. Okay, that's for the upstream. Now go to the downstream. I'm not going to go into detail on the calculation of the 4,000 and so on anymore. I want to show you the difference. Can you see now, because the parent sold this, and for consolidation, this parent or investor, we would include 100% of the line items of the investor into our books. So that's why we will have the other income debited and the income tax expense credited of 1,120. Can you see the top line of the brown journal, the other income, and the bottom line, the income tax expense? That 4,000 less 1,120 is what's affecting P&L. Okay, And because we bring 100% all the line items of the parent into the books, that's why when the parent sold this, when it's a downstream sale, we will bring in both line items. Upstream, on the left-hand side, that 4,000 less 1,120 gives you the 2,880. So can you see the difference there? Look at the deferred tax, exactly the same. Okay, exactly the same, the deferred tax. Investment in associate. So why is this now credited? This is now credited because there's no asset to set off this in the consolidated financial statements. Why? Because I said to you, when there's an associate, the property, plant and equipment of the associate, the line items, all the line items, we will not include 100% by line item. We will only have this one item, which we will call investment in associate. And that's why PPE is not affected, but the investment in the associate. Because remember, if it's a downstream sale, that property is sitting now in the individual books of the associate. But we're not going to bring in line items 100% of the associate. There's only this one line item, and that's why this line item is affected. Ladies and gentlemen, I'm going to pause for 5 seconds. I want you to look at the blue and the brown, and I want you to make sure you understand. And I want you to look at what the differences is. And if you can't do it now in this 5 seconds that I'm going to give you, you will have to do it afterwards. And now you've got the summary. If you understand these and remember these, you will see in the exam that this is not difficult. But because students do not do this, they struggle in the exam when they see the intercompany transactions and they stress out and they mess up. This is not difficult, okay? You will get intercompany sales of either inventory or property, plant and equipment. So make sure you know this. Okay, there's your few seconds. Quickly have a look at this. Let's go to the next slide. Okay, this is now the journal or the calculation. So the next slide will be your analysis. Again, what did I say? So then this will be the analysis of the blue part, the upstream. Okay, the journal of the blue one. Okay, look here in your analysis. You will have the elimination of the profit in your total column of 10,000 Rand. And the tax effect of 2,800 Rand. And then in the sins column, remember when we did that slide? I'm just going to quickly go back through it. Back to it. On this slide, we said we're going to look at the sins movement. So this red, look at the column with the red heading, sins. That is your sins column, so that's what you're going to put in there. Okay, so that's your 4,000 and your 1,120 from the journal we just did. On the other hand, again, look at this. This is now when it is a downstream sale. Okay, so now you can see only property, plant and equipment was affected, so that's not part of the equity, and that's why there's nothing in your sins column. But we said the asset in the consolidation statements, the assets or the property, plant and equipment, which is part of the assets in the consolidated statement of financial statements, will be that one line item, investment in associates. And that's why at your carrying amount column, the last column on your analysis, you will go and take out that unrealized profit of 4,000 Rand. Remember, it's the 10,000 multiplied by the 40%. Okay, so you can see here in this one, look at my little bubble there on top. The associate did not make the profit, so that's why you do not have anything in this column. Again, this is just an analysis, so it will only be a calculation that you'll be using. So this calculation, you need to know where this amounts on this analysis, where will I go and disclose it in my financial statements. So students will, for example, look at this total column let's say the profit of 100,000, and they will look at their exam script or their assignment, and then they will see, but no, you haven't marked this because there is no mark for that specific, as an example now. So please don't look at your assignments and look at the analysis and tell us now, but you haven't marked the analysis. We did. We only marked what was required, and we marked the disclosed amounts. And if it's correct in the disclosure, otherwise we'll trace it back to the calculations, which is, for example, the analysis. Okay, this was property, plant and equipment. Now we're going to look at inventory, and it's going to be the same principle as with the property, plant and equipment. You will have to see, okay, who sold this? Where's my profit? Who sold it? Who bought it? So where's the asset that's affected? And then remember the 40% again, and remember the tax effect, always the tax effect. So again, look at the left-hand side. So in this case, again, the inventory was sold. Let me just go one step back. This inventory, the associate had a profit still of 100,000 Rand. There's still an intercompany profit of 10,000 Rand. And this inventory is sitting at year end. Okay, so it's not yet sold. Sorry, wrong way. So there's your journal for the inventory. So again, this profit and the tax of the profit, if you look at the blue, the 4,000 and the, well, first look at the black, sorry, the 4,000 and the 1,120, that's the effect on the profit, the 4,000, and the tax effect on that profit, the 1,120. So that's your net effect, the 2,880. And we said in the statement of profit or loss and other comprehensive income for an associate or JV, not line by line. That's why I don't put the 4,000 and 1,120 separate, but you put it in as one line item, share of profit in associate. Okay, so not the two line items, one line item. Then again, the profit, the inventory, the credit of 4,000 Rand, if you look at the blue. So because that inventory is sitting in the books of the investor, and that's why we credit inventory. And then the same as with the PPE, the deferred tax stays the same. So now if this was a downstream, basically the same principle as we said with the property, plant and equipment. The line items of this entity, the parent, will be brought in 100% of the line items. And that's why we will bring in the effect of the total revenue and the cost of sale, where we did not do that in the left-hand side. So why 40,000? If you go back here, you'll see the sales price was 100,000 Rand and the original cost was 90,000 Rand. So to make it easy, the revenue, you will take 100,000 multiplied by 40%, which give you the 40,000. You can then go and calculate the cost of sales, which is 90,000 multiplied by the 40%. Or you know this investment in joint associate or a joint venture, you've already calculated it and you know the unrealized profit is 4,000 Rand. So you can also only bring that in, and then the balancing figure is your cost of sales. In other words, the 40,000 less the 4,000. So you can either calculate the cost of sales or you'll see it's your balancing figure. Deferred tax, as I said, the same. And now you can see there's the income tax expense line item again. Why? Because for the parent or the investor, we bring in 100% of the line items. Okay, I'll give you 5 seconds to look at this. Processing. If you remember and understand it now, it's going to make your work easier throughout the studies. Okay, now we're going to look at question 2 from tutorial letter 103. And I've asked you in the invite to this class that I want you to work through it. I hope you have. So we're going to deal now with a few things in this question relating to exam technique, where you get marks, what you should approach you should follow in an exam. And I hope you've worked through it. And if not, then you really need to do it in your own time afterwards. So let's look at this question. What did we say earlier? How to approach a question. We read the required first. I'm not going to read through points 2 to 8 now. You can go and do that in your own time. So let's take it step by step. Okay. Read the required. So let's read the required, because you're going to get the exam question paper and then you quickly go to the required. So we read, prepare only the asset section. And I've made it now red in this slides, but obviously it's not red in the exam. I just highlighted so that you can see what it is that you need to do here. So prepare only the asset section of the consolidated statement of financial position of Papyrus Limited Group as at 30 November 2017 for 30 marks. Okay, so you need to see, okay, this is 30 marks, so I need to work out my time. Okay, work out your time, and then you say, okay, this is the time that I've got for this question, and this is where I will stick to my time. Because as I said to you earlier, you need to stick to your time to make sure you do all the questions in an exam. Remember when I talked about the multiple choice questions? So only the asset section. So ladies and gentlemen, it doesn't help you go, you do the assets, you do the liabilities, and you do the equity, and you go over your time and you leave the multiple choice questions or another question out and you think, well, I'm very smart. I've done this equity and liabilities, and especially this NCI and the equity section. Now I know what I've done. We're not going to give you any mark for that. You've wasted time because you did not answer what we've asked. So read carefully, only the asset section. So the information in the question, yes, will be relevant to the liabilities and to the NCI and as well. But this is what we ask. Then 30 November 2017. Okay. If you see that, you know, okay, this is my financial year. Okay. So all the transactions during that financial year and at year end, but we'll touch on that as we go on. And then you can read the 3 next bullets on your own time. Okay, so look at this. Your financial year will be, based on this date, 30 November 2017, be 1 December 2016 to 30 November 2017. I want you to draw a type of a timeline for you in the exam to say, okay, this is my financial year, because I will record all transactions during this period in my statement of profit or loss and other comprehensive income. Okay, so in other words, if there's revenue during that time, that revenue you will record. But if there's revenue in the period before that, can you see that's not affecting my current year? So that will not be in my statement of profit or loss and other comprehensive income. My year end, 30 November 2017, that is my balances on the specific date. Okay, so that's a snapshot on a specific date. That is your statement of financial position. Okay, your financial year, your statement of profit or loss and other comprehensive income is the transactions throughout this period. I hope it makes sense. Okay, so just as an example, if you look at this financial year, and I think we're going to touch on it in the example that in the question, in the information that's in this question, but if there was, for example, a gain on bargain purchase for a purchase of a subsidiary, say for example on 1 July 2015, can you see that is before this financial year? So that will not be in the statement of profit or loss and other comprehensive income, because the line items in this statement is transactions in the current year. Okay? Happy. Students made that mistake as well. They calculate the gain on bargain purchase, but then it was for a different period, and then they include it here. Whereas, for example, with goodwill, which is in the statement of financial position, if your goodwill in 2015, or let's say 27, was 100 Rand and there was nowhere any change to that, no impairment whatsoever or no other changes, you will still bring for the financial period or financial year end 30 November, you will bring in that goodwill of 100 Rand because that balance is still valid, is still there at year end because we report all the balances at year end. Okay, so now we read through the question. Okay. Because we only have 2 hours, I'm not going to read through everything now. I'm going to, because it's a duplication later on in the slides of all this information. I hope you've read through this. So we might come back to some of this information. I'll just read this first part, but the other points, the additional information, I will not read line by line. We will go through them because we're going to treat each specific transaction. Okay. So, P Limited was incorporated in 1906 and is one of the oldest bookstores in Bloemfontein. So now we just know it's not a new company that started in the current year, so nothing in there. On 1 January 2015, I need to stop here, something happened, okay? P Limited purchased 30,000 ordinary shares, 36,000 ordinary shares in Parchment Limited, a company that exclusively sells Afrikaans books. Okay, obviously the Afrikaans books or whatever is nothing to do with the question. You don't have to stress about that. From this date, P Limited, Papyrus Limited exercised significant influence. Now stop there. We said earlier when I showed you that diagram at the beginning, when there's significant influence, we know this is an associate. Okay? Now we need to go and calculate, okay, what's the percentage shareholding? Because we told you, or I told you that the percentage shareholding when you work with an associate or joint venture is very important and you need to use it all the time. Then you're going to say, okay, the 36,000 shares, and now look down. We need to look, okay, this Parchment Limited, because that's the shares. How many shares do they have? Then we say, okay, share capital. So look there at the bottom of this page. Okay, look at the share capital, 120,000 ordinary shares. But look to the right, the value is 220,000 Rand. What do we use? We compare apples with apples. They've bought 30,000 ordinary shares, in other words, number of shares. So we divide that by the 120,000 ordinary shares. So it's apples divided by apples, and that will give you 30%. So now we know, okay, if we go back, our financial year, apologies, our financial year is from 1 December 2016, okay, and this purchase was 1 January 2015. Can you see this was before this financial year? So just take it into account, and I said to you draw a timeline and put that on your timeline, okay? That you know, okay, the investment in associate was before year end. Right. And then we see the assets and liabilities were fairly valued on this date with the exception of trade and other receivables that were overvalued by 10,000 Rand. Okay, now remember this, we'll come back to this. We go to the next line. Papyrus Limited wishes to further expand its business on 1 December 2015. So what do you see there? You see, okay, but this is on the first date of this financial year we are looking at. Okay, in other words, if there's any transactions in this year, on this purchase, it's in the current financial year. And they've acquired control. Now you know this is a subsidiary. And then we see there in Paper Limited by 90% of the ordinary shares. So already we gave you the 90% here. In other examples, you will have to go and calculate it. We can give you different scenarios, but the principle stays the same. You need to know what the percentage is. Why do we need this percentage? We said then for a subsidiary, we're going to add 100%. Remember why we need it? Because we add 100% for subsidiaries, we need to know the percentage shares hold, in this case 90%, because we add 100% line by line, so we will have to see what the non-controlling interest is. So that will be the 10%. So now already I know my NCI percentage is 10%, which is 100% less this 90%. And then the following trial balances were extracted from the trial balances of Parchment Limited and Paper Limited at various dates. Remember, we asked the asset section. So, but maybe there's goodwill in this calculation, in this scenario. We'll first have to go and calculate it later on. So for now, you just need to know, okay, this is at acquisition dates. If you can look here, 1 January 2015 and 1 December 2016, which was my 2 acquisition dates there on top. So I need to remember, I will come back to this because I will need this information later. Happy? Let's go on. Now we see if we can just have a quick look at this and we see, okay, this is now the trial balances of these 3 entities at year end. Look there on top at 30 November 2017. So I know, okay, I'll have to look at the assets. Now we just scan through and we just look at a few funnies and we see, okay, whoa, if I go down there from top share capital, go with me, and we go down, 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 and I see there deferred tax asset or liability. I'm not even going to look at the right-hand side or the which is now the subsidiary or the associate. I just see, okay, whoa, there's assets and liabilities. So, and at the end, if the assets is more than the liabilities of the parent and the subsidiary, then I will have to put this in my asset section. Now I go down and I say, okay, loan from. So loan from normally is a liability. And obviously, if you look at all these amounts in brackets, they are credits. It's liabilities or equity. It's credits. So most probably we're not going to use it. Then we go another one and I see here bank overdraft. Okay, you know, in this example, it was the bank overdraft of the associate, but let's say this was the bank overdraft of the subsidiary. Always when you see bank overdraft, remember this is one of those funny ones. There's certain rules that needs to be adhered to before you can go and eliminate this bank overdraft against any positive bank balances or cash and cash equivalent balances. Look there at the bottom. Okay. So in this one, anyway, it was those the bank overdraft of the associate. If it were for paper, which is the subsidiary, you will have, before you net them off against each other, you will have to read carefully if we gave you information in the question saying that they comply with the rules and they have the intention to set on a net basis and so on. Okay, there was in the previous exam, if I remember correctly, a nice discussion question as well on bank overdrafts and when you can set off the amounts or not. So make sure you know that, because that's one of those that if we bring it in, it's one of the funny ones. And if you do get it wrong, I really believe although it's funny, it's an easy one where you lose easy marks. Okay, we go down. Now we see property, plant and equipment. Now we see, okay, this is all the assets that we're going to use. Okay. And we see here, if I just look at one and I see here, okay, loan to paper limited or loan to parchment, I think myself, okay, whoa, loan to paper, this is now a loan to my subsidiary. So remember we said we need to eliminate intercompany balances. So loan to paper will be an intercompany balance. If you look 2 lines up or 3 lines up to the line investment in parchment limited at cost, can you see in the books currently of Papyrus Limited, that's how you will name it, investment in parchment limited at cost. But remember what we said, at consolidation, we're going to reclassify it and we're going to call this investment in associate. Look at the amount already given, 430,330 Rand. So just look at this and we'll go to the next slide. Okay, this is now the additional information. I'm not going to read through them because we're going to touch on them because I'll deal with them one by one. And for those who does have an effect on the financial statements, and then at the end of this time we'll go back and see, okay, the others, what did they mean, and did they actually tell us anything? Why do we need it? So let's go on. In the initial part where I said, how do you need to treat a question, is I said, read the required, and then I said, read the information in the question, and let's assume we've done all of that now. And then I just say, read the required again, because sometimes, because of exam stress, you miss this, and this is the important part, because if you miss that only, the asset section, and you prepare the statement of financial position, you waste valuable time. So what's my group structure in this example? My group structure, as we said, is Papyrus, bought 30% shares in Parchment, so that's an associate, and 90% in Paper, and that's a subsidiary. Okay? Now, we said exam technique, you know what's required, go and prepare your skeleton. So look at the skeleton. So just based on the information given in the question, in your trial balances, note them and write them down. Remember we said the positives ones, the ones not in brackets, start writing them down. But you need to know the layout of your statement of financial position, because if you do not know that property, plant and equipment should be under non-current assets, as an example, then you will not get your marks. Okay? So, same with inventory under current assets, as an example. You need to know where it should be classified and presented. So make sure you know the layouts out of your head. What's the two new ones here? It's goodwill and investment in associate. So when you get a question and you've identified there's a subsidiary or associate, I do apologize. If you've identified there's an associate or a joint venture, immediately go and write this line item in, because you will get a mark for this specific disclosure or line item most of the times, and that you remember at the end that you need to go and do a calculation, because there will be a calculation involved in this. And then write down goodwill. Okay, yes, we don't know yet if there's going to be goodwill, because if the subsidiary, if there's only a gain on bargain purchase, then that line item will not be in here. But at least if you write it down and say, okay, but I need to test for you, then you will not forget it, because students forget it in the exam. And even if you struggle with the goodwill calculation, there's always a few easy marks as well, if you just know a few of the basics. So rather write the line item, you'll get the mark for this description, and at least for some of the amounts that you've used in your calculation. Now you take your trial balance and you go and add all these amounts that was given to you. Okay, so if you've got your study guide in front of you, I hope you have, not study guide, tutorial letter 103, and you start then, you look at property, plant and equipment, and you'll see that amount was given to you. Okay, so all these amounts were given to you. It was Parchment Limited's, Papyrus Limited's amounts given. So there's nothing difficult here. If you just write them down, already you have a few marks. Okay, so why didn't we? I'll talk about that in the next one. So only one line item added for associate or a joint venture versus 100% line by line for the subsidiary. So if you look at this, so forget about the blue first, look at the red line items. So the red line items are those of Paper Limited. So you go and add them as well, because it's a subsidiary. We add 100% of them, and there you go, easy marks. Now we know investment in associate. I said to you, if you look at your trial balance given, if you look at 1, 2, 3, 4, 5, 6, line number 7 from the bottom, okay, on the first page of question 2, you'll see investment in Parchment Limited at cost 430,330. This is the one where I said this cost was already given, so you start with that amount, and then you reclassify or rename the description or a line item to investment in associate. If it was a JV, investment in joint venture. And already you've got 2 marks for your associate. Sorry, I've made a mistake now. Not 2 marks, depending on how we've decided or what we've decided how many marks will be allocated in an exam. And normally we allocate half marks as we go on. So typically we'll get a half mark for this description and a half mark for this amount, because there's no calculation or something difficult involved in this investment and associate description and the amount 430,330 Rand. Okay, let's go to the next one. We say, now we're going to look at those bullet points in additional information that I said we're going to anyway now read through it. So let's look at it now. On 28 February 2017, okay, you need to see this is during our financial year. Piper Limited, so that's the subsidiary, sold office equipment, so this is PPE, property, plant and equipment, to Papyrus Limited for an amount of 59,975 Rand. Piper Limited originally purchased this office equipment for 60,000 Rand. So when you see this, you need to see, okay, whoa, it looks like there was a profit on this. But what did I say earlier? When you look at the profit, we can either give you the profit amount or we can give you sufficient information to go and calculate the profit. So if you just look at this, read this quickly, this paragraph, and then you think for yourself if you can calculate the profit. Okay, before I go to the next slide, because I think some of you might have missed it, we gave you the cost price of Piper Limited for this PPE, the 60,000 Rand. Remember, the profit is your selling price, which is the 59,000, less your carrying amount. So we first need to go and work out the carrying amount of this 60,000 Rand asset at 28 February 2017. So let's read further. Piper Limited estimated that the office equipment had a total useful life of 6 years. Total useful life. So this is obviously when Piper bought this, the useful life they've put or added to this asset. So we need to go and calculate the depreciation. It's the entity's policy to provide for depreciation of over the expected useful life using the straight line method, which is consistent with SARS. The only reason why we say this is because then you know there's no deferred tax on that specific useful life versus the tax rate that you get from SARS, okay, on that specific principle. So let's look at this. What's the carrying amount? It's your cost price of the asset, less accumulated depreciation until the day that you sell this. Remember, this was bought, if I can go one step back, on 1 December 2016, and they sold it on 28 February 2017. So it's December, January, February. It's 3 months. So we'll say, okay, 60,000 Rand divided by 6, which was the useful life given, multiply by 3/12, which is the depreciation for the 3 months. So my carrying amount, 57,500. If you just look at this, and I know you can't see marks here, if you just look at this and see that typically in an exam, we will give you marks to calculate this carrying amount. So you'll get the mark for the 60,000 cost price that was used. You will get the mark for the 6 years or for useful life that was used. And if you can see, but whoa, this depreciation was not for a full year, only for a portion of the year, which is the 3/12. So what is my unrealized profit? It's my proceeds. In other words, the amount that they've sold this asset for, and that's the 59,975 Rand, less the carrying amount that I've just calculated, and that's my unrealized profit of 2,475 Rand. So can you see there's already a few marks just to calculate this unrealized profit? And in the example we did earlier, I gave you the profit. So if I give it to you, yes, it's easier, but there's lots of easy marks when you look at this. So how will you account for it? Because the subsidiary sold this to the parent, okay, where does it affect us here? Other income, which is the profit on the sale, will be debited with this 2,475 rand that was calculated here. Property, plant and equipment will be credited as we've done in our example, and then the tax and deferred tax. Okay, so I'm not going to go into detail into this again, but what you need to see here, this was not the associate, this was the subsidiary who sold this. Okay, and because the subsidiary, we also bring in 100% of the line items, we will have to take this into account here. And that's why we debit other income, which was this profit, which is unrealized. Okay, we did not sell this equipment to the outside, to a third party. So for us as a group, we need to rectify our other income and property, plant and equipment and deferred tax and income tax expense. But we only work with, the only requirement of this was the asset section, and that's why I've highlighted it in blue for you, because now you need to know, okay, this effect of this transaction, everything that we've read, only affect our property, plant and equipment line item. It's going to reduce. Can you see credit? It's going to credit or reduce our property, plant and equipment item, and we will increase the deferred tax asset. So let's put it in. There you go. In the skeleton, minus 2,475 rand at the property, plant and equipment line item. Can you see it's only two amounts? If you look at the two red ones, it's only two amounts that's affecting the question that we've asked in this scenario. But look at all the amounts in the calculation. The cost given, the useful life, the depreciation months, the proceeds, then you've got your profit. After that, you need to say, okay, but this was my profit. What's the tax effect on this profit? So you need to remember the 28%. So there's quite a lot of principles tested in only these two amounts. And this is not difficult. Let's go to the next one. Okay, if you just look at that, what do you think we miss? About the depreciation on this asset. Remember, this asset was now sold between the subsidiary and the parent. So this equipment is sitting now in this group at a higher amount that we've just reduced now with this unrealized profit. But if we've reduced the property, plant and equipment item, we should look at the depreciation effect on this 2,475 as well. So let's look at it. The remaining useful life of this asset was 69 months. How do I get to it? The 6 years was given. So 6 multiplied by 12 gives you 72 months. The 3 months when it was still in the subsidiaries books, okay, is 3 months. Remember the December, January, February. So the remaining useful life is 69 months. Okay. Therefore, the depreciation adjustment from 1 March until November needs to be taken into account. So that's 9 months. So 2,475 rand, look at the bottom, divided by 69, which is my remaining useful life. It's actually 5 years and 9 months. That gives you also the 69 months. Multiply by the 9 months, the depreciation months that I need to work with. That's 323 rand that we need to take into account. So what will we do? Normally depreciation will reduce my property, plant and equipment. But what's the effect here? The effect here is we've reduced now with the 2,475 rand, our PPE. So the effect of the depreciation will be opposite. So let's look at the journal. Accumulated depreciation, we will debit. Other expenses, which will be your depreciation, will be credited. And then the tax effect, always consider the tax effect. Okay? Because this is the statement of financial position that we've required. I've highlighted in blue for you only the effects on the asset section. If we look at the effects on the asset section, and we put it on your skeleton. So I just want to go back one here. There it is. Look at my note here at the bottom. No separate line item for accumulated depreciation in the statement of financial position. It's part of PPE. Students sometimes bring this accumulated depreciation as a separate line item in your financial statements, and that's not correct. It's one line item. So look at the red ones. The 323 you add back now, and the 90 Rand on the deferred tax asset you deduct. Okay, nothing difficult there. Okay, now we're going to account for the associate. I'm not going to read through these steps again because we've done them earlier, and you can read in your own time as well. I just want you to remember, and I've said it before, always remember to multiply by the investor's interest. In this one now, the 30%. Okay, if not, you're not going to get your mark. So even if you do some of the principles correct and you do not multiply it by 30% and you treat it as if it's a subsidiary by adding 100%, you get 0 for that specific items affecting the associate or JV. So let's look at this. We said at the beginning, what do? The first step is we only reclassify the investment in associate. Okay, so in the original books, it was, for the parent, it was investment in Parchment Limited at cost as a debit. So you'll just go and credit it and debit the investment in associate Parchment Limited. So can you see the only difference is the name or the wording that changed? And we've already showed you that one. And this is what it looked like originally in the TB given to you. Investment in Parchment Limited at cost, 430,330. If I go back one, you'll see only the wording changed. Okay. Now we're going to look at goodwill or a gain in bargain purchase of this associate. Okay, remember what we said, if it end up being a goodwill item, it's already included in the 430,330 for associates, remember, and JVs. Then you do not do anything. But if it's a gain on bargain purchase, we'll see. Okay, so we're going to take the share capital given. Remember, if you go back to that very first slide, or in your question on the first slide, the info given, the share capital given was 220,000 Rand. You multiplied by the 30%. Then your retained earnings at acquisition date. Now that was not specifically given to you. So that's one of those. Sometimes we'll give it at that date. Sometimes you'll have to calculate it. So you know when the acquisition date was. So you'll say, okay, I'll take my 1,060,000 retained earnings at 1 January 2015. Okay. And then what do? What do we have to take into account there? Remember at the very first slide, if you look at the first slide, the first page of the question given and the first slide of this question, the very first paragraph at the end, we said the assets and liabilities of Parchment Limited were fairly valued on this date, with the exception of trade and other receivables that were overvalued by 10,000 Rand. So if it was overvalued, we need to reduce that retained earnings. And that's why we say 10,000 with the after-tax effect, in other words, multiply by 72%. That 72% is just to take the tax out, gives you the 7,200. And now I know, okay, the 1,060,000 Rand given to me was now adjusted to my final balance at date of acquisition. So revaluation surplus, 210,000. So we look at all the equity items now. That 210,000 at acquisition date was also given to you on the first page of the question. Look at revaluation reserve, the column Parchment Limited 1 January 2015. When was that? When it was the acquisition of this date. So 210,000 again multiplied by the 30% gives you your 63,000. Now you've got your equity at acquisition date. That's the 440,840 Rand. What did we pay for this investment? We paid 430,330 Rand. Can you see it's less? So what is it when we pay less for something? We receive a bargain. Okay? If you go to Pick n Pay and something costs 20 Rand and they suddenly charge you 16 Rand, you've paid less, you got a bargain. It's the same here. Okay, so the gain on bargain purchase. I'm just going to stop here quickly. So, remember, for an associate, this is an associate, normally we bring in only that one line item in the statement of profit or loss and other comprehensive income. So, if this was in the current financial year, this would have been part of my share of profit in associate line item in P&L. But because it is in the previous year, we would not include it. But anyway, this is just for you to know. We're working with the statement of financial position here. Let's go on. Okay. This is your analysis of owner's equity, and there you'll see, but whoa, the gain on bargain purchases will affect my carrying amount of my investment. Why is that? Because every transaction have a credit and a debit. And the debit side of this transaction for the gain on bargain purchase is sitting in this line item, investment in Parchment Limited. Okay. So how do you account for this? Investment in associate, which we've just saw, and the credit is retained earnings. Why retained earnings? I've basically just covered it when I said earlier, because this transaction was prior to the current financial year, because the acquisition date was 1 January and the financial year started at 1 December. So can you see there, if it was in the current year, this credit would have been share of profit in associate. So then it will affect your statement of profit or loss and other comprehensive income, and it will be, the debit will be exactly the same. So there we go, and update our skeleton. Okay. I've said earlier, if it was goodwill, obviously this was now a gain on bargain purchase. If it was goodwill, you would have done nothing when it is an associate or a joint venture, because it would be already included in that cost of 430,330. Okay. You can go and read this in your own time again. Now we're going to look at the plus, the sins portion. So you need your movement in equity reserves since acquisition. Can you see it there? Look at the plus, change in equity since acquisition. Okay. So that is what is since acquisition. It's from the date of purchase, which is 1 January 2015, up until the beginning of the current year. Okay. So 30 November, 1 December. Okay. 1 December is the beginning of the current year. So we look until the day just before that, 30 November 2016. So what was my retained earnings at the beginning of the current year? Now you need to look at, again, page 1 of the information given. And you look at the retained earnings column at 1 December 2016, the 1,480,000 Rand given to you. Less. Now we need to do a calculation again. We've done it earlier. Okay, less the retained earnings at acquisition, the adjusted retained earnings at acquisition. And that gives you, you need to multiply it by 30%, remember, 128,160 Rand. Okay, now we know that's the movement on retained earnings. We look at the other equity items, and you look again at the information given, and you see, okay, the revaluation reserve at acquisition was 210,000. So look on your information given in your question in tutorial letter 103. And that 210,000 increased up until the date of the beginning of this year, 1 December 2016, to 245,000. So we need to account for that difference. Multiplied by 30%, you get 10,500. There's your total since acquisition. Nothing difficult. So how do I account for it? My investment in associate, I will debit. I will credit retained earnings and revaluation surplus. Okay? Happy? There's the amounts. So let's go up. We added there. Look at the red one. So this is now the since acquisition date to the beginning of the year information that we've taken into account. We're going to look at the last one now. We're going to look at the current year information. All right, so the profits for the year, where do I get that? So this 1,630,000, this was again a funny one. Normally in the exams, we will give you information where you can easily identify, for example, or to calculate your profit. We will say, for example, it is the revenue was 100,000 Rand and the cost of sales was 60,000 Rand. So that's 100,000 less 60 gives you 40,000. And let's say now the tax was 12,000 Rand. And then you will have to go and calculate the profit. This was a funny one. You know the principle. The principle is I need my profit for the current year. So what did we give you in this example? Look on the information given again. We gave you the retained earnings at year end as well. So look at the trial balances given to you. Then you'll see the share capital on top and then the line item retained earnings. So the retained earnings at 30 November 2017 means this is everything with my profit for the current year already included there, 1,630,000. So how do I get the total for the year? I'll say, okay, less the balance at the beginning of the year. What is my balance at the beginning of the year? It is 1,480,000 Rand, also given. Now I know, okay, this is my profit for the year, but whoa, there's something else. Included here was 30,000 Rand of dividends in the information given that was already subtracted from this 1,630,000. So we need to add that back to get to the profit. Okay, so this 30,000 that you see there was actually now already taken into account, deducted from the ones to get to the 1,630,000. Okay, and because it was already deducted, we need to add it back to get to the profit for the year. And you multiply it by the 30%. And now you know what your amount is, 54,000 Rand for the current year. Your revaluation reserve, the 290,000 again was given to you in this question, less the 245 at the beginning of the year. So multiplied by 13% and you get your difference for the current year. So can you see for the current year, everything that's going into the statement of profit or loss and other comprehensive income, and we'll see now what's the other leg, is 67,500 Rand. Okay. So investment in associate and share in profit in associate. Investment in associate and share in other comprehensive income. Okay, so just look at the two debits. The two debits is what we're going to use now, is the investment in associate. That's just those two amounts added together. And the credit, look carefully here. If we had asked the statement of profit or loss and other comprehensive income, it would be two separate line items. Share in profit of associate, okay, of 54,000, the normal one. And the other one is the share in other comprehensive income as part of your other comprehensive income, more towards the bottom of your statement of P&L. Can you see the difference? Okay. So let's look at the statement of financial position. So we add the 67,500 as we said. those two amounts added together. The only effect is there's only one line item of the associate in the statement of financial position, and there it is. The next one, point 3 from the slides, from the additional information given. From 1 January 2015, Parchment Limited purchased inventory from Papyrus Limited. Can you see what's happening here? The previous one was property, plant and equipment. This time, inventory. So who's selling here? The parent, the investor. Papyrus sold the inventory at a profit of 25% on cost. I've highlighted this because I want you to see that you can get sometimes 25% on cost, or we can say on the selling price. And then the calculation, how to get to your unrealized profit, will differ. Go and make sure, I think I've explained it properly in my second class. Make sure you understand it. The total sales amount amounted to 400,000 Rand in the 2016 financial year, which was last year, and 620,000 in the current financial year. Inventory purchased from Papyrus Limited that was still on hand at year end was the red one last year, 90,000, and the green one is the current year. So what we will have to do, we will need to take into account the unrealized profit. And now we see, but okay, there's opening and closing inventory here. And let's see what the effects are. It's a downward sale. Okay, I've highlighted again here. Remember, we've covered earlier downward and upward. You need to know them out of your head. Okay, what is the unrealized profit of the opening inventory? It's 90,000, which is the opening in that's now the closing inventory of the previous year. Let me just go back. The 90,000 is the closing inventory of the previous year, will obviously be the opening inventory of your current year. Okay, so 90,000 multiplied by 25 over 125, because it was on cost. If I had said on the selling price, you would have said 25 divided by 100. And then remember, the interest in your associate is 30%. We only take that, the investor's percentage out. So it's 5,400 Rand. Okay, I think we've covered enough inventory, intercompany journals, and in this session and in the second class. You can go and look at this in your own time. So you just see, okay, we need to take the tax into account as well. Remember that. And because, what did we say? This is a downward sale. We say, okay, whoa, because it was the opening balance, we need to affect retained earnings. Okay, so look at the effects on the assets, on the statement of financial position. It's deferred tax asset and investment in associate. Okay, but now this opening inventory is realized throughout the year. If it's realized throughout the year, it means you sit with that at the end of the year, and that's why we do at the end of last year, and that's why we sit with these balances that we need to fix at the beginning of the year. Ladies and gentlemen, I do apologize if you do hear my dogs bark at the outside. That was not part of the planning of this session. It's the city of Tshwane coming to clean the dustbins, so there might be a little bit of noise in the next 2 minutes. I hope it's not disturbing you a lot. That was not part of my plan. Let's go on. So that's your closing inventory at the end of last year that you're now fixing your opening balances. But then because of that balance is sitting in your books, now you're going to sell that inventory. Remember, it was unrealized, but now the group's going to sell it. And then you'll do these adjustments. Okay, so go and look at these journals, and then you'll see, but a lot of them cancel each other out. Okay, because it was last year at the end of the year, you fixed the opening balance, and now you fix the opening balance, but then they actually cancel each other out. And then you just look at what the remaining balances is. I think this is a nice summary for you that you need to take into account and study when you get closing and opening inventory. Because with the opening inventory, you would have done last year exactly the same that you will do this year with the current closing inventory. And then the only difference is you've adjusted now the opening inventory, but then those inventory will be sold to external parties throughout the year. Okay, so the effect on the investment in associate and deferred tax is therefore zero. Remember what I've showed you. Look there. Look the lines across the red and the yellow. It's zero. Luckily, no effect on the question that we had. Now we look at the closing inventory. So I'm going fast through this. It's not affecting our question, the statement of financial position, but I want you to go through this slide and understand, because obviously if you look at this slide, you will see the effects on the other parts of the financial statements. So now we look at your closing inventory. So your closing inventory was given as 130,000. Same principle, multiply by that rate and multiply by the 30%. Now you see, okay, the unrealized profit, 7,800 Rand. Okay, the investor sold. So what are we going to affect here? It's affecting the inventory loss of the associate in the balance sheet. That remember, in the statement of financial position. But remember, we said there are no such item because you don't add them line items 100% for each line item. So you will add them in the investment in associate line item. Okay. In other words, not add, sorry, you will deduct it, you'll credit it there. And then the tax effect. So let's include it there. Okay. Now we've updated with that transaction. Now I've talked earlier about the dividends as well. Remember that slide when I showed you these steps? Look at the bottom one, the very last one, dividends received, reduce the investment. That's the one we're going to do now. Okay, Parchment Limited is now the associate, declared a dividend of 30,000 Rand. So in the investor side, he will reduce his other income. Remember when he received it, he increased the other income, but now for consolidation purposes, we take that out. That's why you debit other income, 30,000 multiplied by 30%, the investor's share. Okay, but luckily there's no effect with that now on our statement of financial position of the debit leg. And then you look at the credit leg that I've just showed you. The investment in associate is then credited with this 9,000 Rand. So now we deal with that last point that I've just showed you. Investment in associate, there you go, you credit it. 9,000 Rand, so you deduct it. Why deduct? Because the investment is an asset. The journal just showed us it's a credit, so that's why we deduct. During the current year, Papyrus Limited, who's Papyrus? It's the subsidiary, sold inventory up to the value of 100,000 Rand to paper at a profit markup of 40% on the selling price. Here's the different one. Okay, on 30 November, he had inventory on hand at 60,000 Rand. So look, what's the difference here? So the first difference here is this was now sold by the subsidiary, not the associate. That's the first thing. The second thing, we talk here about the profit markup percentage on the selling price. So that's going to be there, not 40 divided by 140, like the 25 divided by 125 in the previous one. It's going to be 40 divided by 100. And we see in this one, there's luckily only in closing inventory. Just take that 100,000, take it into account. We'll talk a little bit about that as well. Again, let me just see here. Yeah, sorry. Okay, again, it's a downward sale of inventory, but to the subsidiary. Only closing inventory relevant here. You can go and do the calculation. So at 60,000 was the closing inventory, multiplied by 40 divided by 100 gives you your unrealized profit of 24,000 Rand. Okay, this was now between the subsidiary and the parent. So remember, that's why we don't multiply here by the percentage interest, because for subsidiaries, we work with the 100% because later on, we'll take the NCI out, the non-controlling interest. Okay, look at the slide. So we say the 100,000 that I've just told you, this is now something different here. We're going to affect because 100% of the line items was taken into account of the parent and the subsidiary. We need to rectify the line items. I think I've covered this in the second class as well, but I'm just going to say quickly. So for example, for the parent and the subsidiary, 100% of the revenue was included, but this 100,000 rand that you see here was now included, but it's not to the outside or to a third party, and that's why we reduce our revenue. We debit it, and that's the same for cost of sales here. Okay, the 100,000 rand. Now we're going to take out this unrealized profit of 24,000 rand, and who sold this? The subsidiary sells to the parent. Okay, in this case, when it's a subsidiary and it's a parent, you're going to affect the inventory line item by 100% of this unrealized profit, and that's the 24,000 rand, and we take the tax effect into account. Okay, so we'll come back to this slide now. So there you can see there's my deferred tax that was affected, and then the inventory that's sitting at a higher amount for the group that we need to reduce now. Remember the unrealized profit, it reduces the inventory, and the opposite effect on the deferred tax asset. Let's just go back to this one. What I want you to do is I want you to go and have a proper look at the difference. Print these slides maybe for you and put them next to each other and see the difference when the inventory is sold to a subsidiary versus associate. Okay, see the difference in line items and make sure you understand them 100%, and then if not, contact us. Okay, because it is sometimes a bit confusing. It can confuse you a little bit, all these words and descriptions and associate and who sold to who and who is the subsidiary and associate, but make sure you write them down and then you will understand it. Okay, then the easy one. Actually, I've done this now a little bit later, but these easy ones you need to go and do from the beginning. So loan to paper limited, remember 100% of consolidation we will take of the intercompany balances, we will take out. So there was a loan to paper, which was a subsidiary. So if there's a loan to paper in Papyrus's books, it's a debit because they're waiting for that money to come in. Now on consolidation, we take it out because we're not going to get any money from an external party. So there was no sentence to show this. You should have picked it up in the TB. So in the information given, in the 1, 2, 3, 4, fourth line from the bottom, on the trial balances given, you'll see loan to paper limited, 45,000 rand. I hope this makes sense to you. That's one of those very easy marks because it's straightforward. Okay, now we look at the goodwill or gain on bargain purchase of the subsidiary. So this information on the top was given. Papyrus wishes to further expand its business, blah, 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 blah. I want you to see the date. It was December, in other words, at the beginning of the year. And you will see 90% was bought. And then the assets and liabilities were fairly valued at this date. That just mean you don't need to make an adjustment. So the following balances were given to you. So now look at the right-hand side. So the share capital at acquisition date, because look at the 1 December and 1 December, the same dates, was 100,000 rand, and retained earnings 90,000 rand. Then I just took a portion of additional information out here. Point number 8. The Papyrus Limited Group elected to measure non-controlling interest at their proportional share. And the only reason why I highlight this is because in the second class I told you there's two ways how they can measure it. And the one is at the proportional share, and the second one is at fair value. And only when it's at fair value, your NCI will share in goodwill. So luckily this time not, so we can go and do the straightforward calculation. So consideration paid, 185,000 Rand, that was given to you in your trial balance. Okay, the purple one given in the trial balance to you. If you look at your trial balance and you'll see investment in paper limited at cost, then plus NCI. Just remember there's more than one way how you can calculate this goodwill, and I think it was discussed in some of the classes or in the notes you'll see or in old questions. You need to find what works for you and what you understand. Okay, so consideration paid 185,000 plus non-controlling interest. So that's 190,000. What is the 190,000? That is the share capital and the retained earnings of the subsidiary. Okay, that's the equity multiplied by 10%, which is the non-controlling interest. And we said at the beginning, how do we get that? We as a company, as a parent, Papyrus owns 90%. So if we own 90%, the NCI, the remaining is 10%. So you plus the NCI, which is 19,000, less your net asset value. In this case, it was very easy, no changes, the 190,000. And remember what we said, if we pay more, it's goodwill, because that means they're sitting in this net asset value. There's an asset value, and that's why you want to pay more. And that asset is goodwill. Okay, goodwill will be in your statement of financial position. You can look at this journals. I think we've covered this through some of the other sessions as well. But the balance that we're going to use here is goodwill. There's your 14,000. And there's your finishing touches, your complete set of statement of financial position, given to you. Okay. So, one thing that I want you to remember, on in this question, if I remember now correctly, we did not say anything about the impairment of goodwill, but goodwill needs to be tested for impairment every year. Okay? Ladies and gentlemen, I'm done with this question, and this question was only the asset section, as I said, as was required. So I want you to take the same principles of this question, of the information given. You've got the journals now, and you've got most of the explanations on all the line items, and see if you can compile the other statements as well. In other words, the statement of profit or loss and other comprehensive income, and the statement of changes in equity. The principle stays the same. You need to follow an approach and make sure you know which transaction affects what line item, and then just take it into account in what was required. Obviously, now the way we do it here was just for explanatory purposes, and that's why it's taking so long. So you need to get a method to make sure that you can do your questions in your time. So get a method that works for you and a method that you understand. Your method should just be in line with the principles. Okay? In your own time. As I said at the beginning, we only had 2 hours for the session, so there's no time to do the next question, which I gave out on the announcement. Hopefully there was a few of you who attempted the question. If not, now's the time. Go and attempt that question, because in that question, question 2 of the May-June paper, there's the requirement was a little bit different. The requirement there was the statement of profit or loss and other comprehensive income, and a statement of changes in equity. First, try it yourself. So follow a type of approach that I've just done here, or that was done in any of the classes, maybe one of the first 3 classes or this class. Follow approach and see if you can get to the answer, and see if it makes logically sense to you. And then when you're done, you follow the slides in this that will follow, because I've got slides here for you that you can go and use in your own time with this question, but I want you to do it yourself first, because that is the way you study and learn the best, is if you do something yourself first and you get the difficult concepts and you figure it out yourself. And wherever you struggle, make use of the email address and contact us. I'm just quickly going to scan through the slides to get to the end of my slides, so you will be able to see this. Let me just go up quickly. For purpose of the video, I will just go a little bit slower, and then you can see all the slides, but this will be made available on PDF as well on my UNISA during the coming week, and then you can use the PDF document to go through these slides and to do that question. But as I said, first do it yourself. So if you can just give me 20 seconds to go through this to my last slides. Just going to go like this. You will see here there's explanatory notes on all of these as well. If something is unclear, email us. Make sure you understand what we try to explain to you. Okay. Almost done. Almost at the end of this. Okay. After you've done this, and after you've done this discussion, well, listen to the video that we've just made, or if it was a live if you listen to the live discussion and you've studied Learning Unit 3 and 4, I want you to go to the assessment criteria at the end of Learning Unit 4 and 5 and make sure you will be able to do all of them. If not, then obviously you've missed something today or through your studies of the learning units, and then you need to contact us. I'm not yet done. I'm wishing you all the best for your studies. Please don't leave this yet. There's something else that I need to say. All of the best. Make sure you study hard and study smart. And if you need advice, you've got our email address. I gave it at the beginning, and our telephone numbers. Make use of us so that we can make this route for you very easy, or at least easier. Ladies and gentlemen, thank you for attending the session. There's evaluation forms at the following link. Obviously, this is just a video, so you can't click on this link, but this link is also available at the announcement that I've issued for the session. We will really appreciate if you can go for this class and the previous 3 classes to give us feedback. We need it because this was a new way for us to present these classes as well. So please rate us, and if you've got any ideas, you can complete them there as well. And hopefully we can do this and make this better for you in future and present more of these type of classes. Again, I wish you all a very nice weekend ahead of you. I think you've done your part, at least for this afternoon. Maybe tonight you can go and study again. All of the best of your studies, and remember, start early, study hard, and study smart. Thank you very much.